So anybody anticipates that they will have a significant liability or a significant capital gains liability on disposition or death should certainly be considering this structure.
Good morning, Alan. Thank you for spending some time with me this morning. This will be the first time I have recorded a conversation like this that we hope to host on the website and share with our clients and other interested parties to pass on some of the wisdom that we're going to get from you today. So just to introduce you to anyone listening to or watching this podcast, Alan is the chairman of Loopstra Nixon, one of the fastest growing law firms in the country with over 100 practicing partners. And Alan has played a large role in helping them get to that size. And Alan focuses a lot on working with multi-generational family businesses and high and ultra high net worth investors. So we thought, given some of the news of late and just the relevance of taxes to many high net worth people, we thought we would talk about estate freezes today and have Alan share some of his wisdom with us. So welcome, Alan, and maybe you can frame some of your thoughts and maybe begin by just telling us what an estate freeze is and how it might apply to many people's lives.
Sure. Thanks for having me, Patrick. The estate freeze is something that is sort of at the core of any financial or wealth transfer plan in Canada. And it has sort of arisen due to a number of different factors with the Canadian tax system, how we tax capital gains, how our probate tax system works, the way in which we tax trusts. All of those things feed into this structure being a very common vehicle that families use to both plan for the ultimate succession event, but also to minimize the amount of tax payable on death and to defer out tax in some cases up to an entire generation. And so the estate freeze itself, I think, is something that we introduced very early into the discussions with high net worth families, and it has a number of different functions. And I think one of the goals we have to here today is to maybe demystify that and provide a bit of background to people who might have heard that from friends at the golf club or friends that may have undertaken a estate freeze and might be wondering whether or not it makes sense for them.
Mm-hmm. Who is the typical person that should consider an estate freeze?
I think the estate freeze is anybody that sees themselves having significant future growth in the value of the assets. At the core of the estate freeze is really deferring the taxation on growth in the asset mix from today until some disposition event. That disposition event can be the sale of the family business. That disposition event might be the sale of a significant asset, or that disposition event might be the unplanned deemed disposition that happens when someone passes away, and the Canadian Income Tax Act steps in and says that notwithstanding the fact that you haven't sold any assets, you're deemed to have sold them and you're going to pay your capital gains tax now, whether you're ready to or not. And so anybody that either today has a significant capital gains tax liability that they are sitting on, or anticipates that they will have a significant liability or a significant capital gains liability on disposition or death, should certainly be considering this structure. And in most cases, an estate freeze is going to make a lot of sense.
What does the structure look like? And does the person who is completing the structure lose control at that point in time?
It's a good question. One of the first things that we say in respect of control to our clients is to, in your own mind, try to separate the concepts of ownership and control. And one of the things we're doing is trying to isolate ownership and control so that we can deal with them entirely separately. And that means separating the economic interest in the future growth from control of the future growth. So I'll explain how we manage for that control issue in just a second. But if you're watching at home, just try to isolate those issues. What actually happens in an estate freeze, in the simplest form, is we take the value of a pool of assets today and we figure out what they're worth. And the owner of those assets today converts an interest in a growing portfolio of assets, whether that's a business or whether they're private assets, into a fixed value instrument, usually in the form of a preferred share or a special share that has a fixed value. And so if we use round numbers, if we had a $1 million asset value in a in a company or in a pool of assets, we would have the individual undertaking the estate freeze or the family undertaking the estate freeze exchange what is a growing asset for a fixed value asset. And what that permits us to do then is to issue new shares or to issue an interest in the growth. And that growth can be moved into any number of vehicles. If you wanted to give that to an individual, you could move the future growth to an individual. But more often than not, what we find is that we're moving that future growth into a discretionary trust, or what you may hear as a family trust. But a family trust is essentially a trust where typically the trustees of that trust have the flexibility to allocate both the capital asset, the actual shares themselves, and the income on those capital assets among a wide range of beneficiaries. And that range of beneficiaries can change from year to year. So it's the most flexible vehicle that we know of that is also tax efficient, where you can park future growth. And for the individual undertaking that estate freeze, when they do park the future growth in this trust, they're able to still maintain control through the trusteeship of that trust. And so the trustees of that trust will control how the future cash, future income, and future capital is allocated amongst the portfolio of beneficiaries. So in a typical estate freeze, if we think of a simple family where the patriarch has shares in the family business, those family business shares are frozen in the hands of the patriarch, such that the patriarch now has a frozen class of fixed value shares, and a family trust is created. The family trust has listed in there all of the next generation of potential recipients. That can be kids, that can be grandkids, and they're listed as beneficiaries of that. And then the patriarch would assume control along with one or two additional trustees over that trust. And then as we play forward over the number of years, the patriarch's capital gains liability on either sale of the business or on death is crystallized equal to the amount of the fixed shares, and the future growth accrues to that next generation. And then ultimately, when you hit the liquidity event, whether it's a sale of the company or death, you have the flexibility in that trust to allocate out both the capital gains liability and the income from that liability, or the income generated by the assets among those beneficiaries. And so it kind of creates the best of all worlds from a Canadian income tax perspective.
At what point in somebody's wealth creation should they consider an estate freeze?
It can be considered really at any point. Typically what we see is a family that has established net worth, and they're coming to the point where they see themselves having sufficient assets that they are looking to defer gain on death rather than use up those assets during the lifetime. So that's an appropriate time to introduce an estate freeze. However, if we think about what the estate freeze actually does, really what's more important is introducing the estate freeze as early in the growth cycle as possible. And what I mean by that is that you might be a entrepreneur starting a tech company who's anticipating significant growth into the future. And so you have an opportunity today to freeze your shares at a fairly, modest value compared to what you're expecting 5 to 7 years in the future, and to then split the liability among the next generation. And why that's so important, I think, is that in Canada, we have what's called the lifetime capital gains exemption. And the lifetime capital gains exemption provides a full exemption from capital gains tax on up to $1.25 million of qualifying small business corporation shares. And that is probably the largest tax planning opportunity for any entrepreneur in this country. And the reason for that is that you can multiply that exemption by as many beneficiaries as you'd like. And so a grandparent that might have 14 different grandchildren, if it's structured correctly, would be able to shelter or exempt from capital gains tax the full value of $1.25 million per grandkid in those circumstances. So it really is a missed opportunity. But the entrepreneur that may have a fairly modest value simply splitting that value among the immediate family members, spouses and kids, um, will multiply that by every potential beneficiary, because that future growth will be sheltered. So a lot of what we do when we're educating clients is to introduce it much earlier in the process, because the nomenclature estate freeze, I think, has people not thinking about it except in terms of succession through death. Um, but really what it is it's an asset freeze or a value freeze that's going to create an opportunity for you to split first future capital gains over multiple beneficiaries.
So can you give us an example of how insurance might factor into a strategy like this?
Sure. The one thing when it comes to tax planning on death is the uncertainty of what's called a deemed disposition. And so from first principles in Canada, when you die, you're deemed to have sold every asset that you have for fair market value and to realize a capital gain on those, whether you sell them or not. And that means that for most people that have growing asset values, they're going to have a significant and uncertain liability on their death. And we see news articles most recently in the Globe and Mail, but we've seen a number of them over the years where a family is shocked by the impact of that sudden tax liability and immediately has to set about selling off assets or borrowing significant sums of money to try to maintain or meet that tax liability. Where insurance is helpful is that once we achieve certainty as to what the capital gain on death is going to be, we can match that with an insurance strategy. And what I mean by that is that if you know that you're going to have a $2 million tax liability on death, now we can come up with an insurance plan that gives you $2 million of guaranteed tax-free income on death to meet that tax liability. And you don't have to worry from that point on, because you know that you've parked the future growth in those assets in the next generation such that it's
Hmm.
not part of the deemed disposition. So anything that sits in the family trust or anything that's been deferred as future growth is not deemed to be disposed of on death. And for the amount that will be deemed to be disposed of on death, you know exactly what that number is, and you know how to plan for that. And insurance allows you to match the liability with a tax-free insurance payment that will meet that liability. And so, certainly convenient, but when it comes to a family business, it can be existential in the sense that
Hmm.
you're deemed to sell the entirety of the business, even if that's not your intention. And so a lot of businesses have been forced to be sold or to take on very cumbersome financing on short notice to meet that liability. Whereas if we can freeze the value of the family business now, plan for that tax liability, and defer out any tax on growth between now and death, um, the actual death itself is not a financial crush to the company. There's an insurance policy there that matches the value. And the ideal time for that obviously is as early as possible, because things like a whole life policy or permanent life insurance are cheaper the earlier and the longer you can have those liabilities. And so we see people now looking at freezes earlier and earlier in their life, in their kind of early to mid 40s as an option. Um, and then that's able to be matched with a very good insurance strategy. Certainly when you get up to the ages of, you know, 60, 70 and have difficult time getting cost-effective life insurance policies at that point, you're going to regret not having considered that insurance policy earlier on to meet that capital gains liability.
So for the person who's just a hard charging, inspired entrepreneur who lives and breathes their business and focuses on it all day. And we know lots of people like that. They're very good at what they do. They understand their business very well. Many of these things are details they don't want to deal with on a day-to-day basis, and I can relate to that. What would the process be for someone who knows this is something they probably need to take a look at?
The process itself, is not an incredibly cumbersome one. Typically the banks are familiar with this. These are tried and tested structures. They're not high risk structures as far as CRA is concerned. But essentially what you're going to experience is you're going to have to value the assets that you want to freeze. And so to the extent that those assets are public market securities, then that's a fairly simple valuation exercise because you're simply marking them to market. Real estate, if there's real estate assets in there, they're going to have to be appraised so that we can justify the value that we're freezing it at. But where the challenge comes is in a private operating business, you're going to have a professional valuation of some kind done on your business. And the reason you do that is twofold. One, so you know that the person receiving the fixed value shares is getting the right number, but also so that Canada Revenue Agency respects that freeze. And the standard that Canada Revenue Agency is using in those cases is that they need to see that the board of directors have taken reasonable steps and acted in good faith to determine a fair value for the company. That usually involves the retention of a chartered business valuator to provide you a valuation report to rely on for the company. Once we know what the asset values are, then we use either Section 85 or Section 86 of the Income Tax Act to freeze the value of those shares on a tax-deferred basis, essentially an exchange of the founder's common shares for fixed value preferred shares. And if the founder wanted to hang on to control of those shares, those fixed value shares can still come with as many votes as you want, so you can still maintain control through those shares. And then what we would do is we would create a new family trust. That family trust would be settled by a third party that has no interest in that trust. And that's an important part. You'll see things where the trust settlor gives a $20 bill to settle that trust so that the trust exists. And then the trust will subscribe for new shares in the corporation. And because the corporation's value currently is entirely tied up in the fixed value preferred shares, those new common shares can be issued for $1 for nominal consideration to the trust. And that's the magic that allows the shares to be worth $1 today that go to the trust. But instantly, as the business starts to accrue future value, that value now accrues to the trust and to its beneficiaries. And the person who has completed the freeze now has a locked-in tax liability. And so the longest lead time there in preparing for the freeze is going to be the valuation exercise. That's going to be the most expensive piece of the trust. And then beyond that, forming a discretionary trust, there may have to be some holding company built into the structure depending on what's existing and some legal work. But certainly the tax value is there for people that do these transactions, particularly if you're able to use a lifetime capital gains exemption. You're deferring 1.2, or not deferring, sorry, you're eliminating tax permanently on 1.25 million of capital gain for every beneficiary of that trust. So it's the most obvious way to just simply eliminate tax in an efficient way from a structure that exists here in Canada.
Well, that's very informative. And for clients of our firm, we're very fortunate to have you as the chair of our strategic advisory board, and you have generously offered free consultations for clients who work with us to discuss these kinds of matters. For people who aren't working with us, I'm sure you don't mind if they reach out to you directly at Loopstra Nixon and pick your brain on some of the things that we've talked about today, because I'm sure this is an issue we could dive even further deeper into. But for most people's attention spans, I think we've probably hit the limit, and appreciate a really dense conversation of great insights. So thank you very much for your time this morning, Allan.
Yeah, no problem. I mean, we're always happy to chat about these things, and it's a fairly simple analysis to see whether or not this is something that can help an individual or family struggling with how to marry their estate with a very good wealth transition plan.
Yeah, great. Thank you so much.
Thank you. Appreciate it, Patrick.